Your retirement account just became 23% more expensive to protect. Not next month. Not if conditions deteriorate. Right now. The cost of insuring a portfolio of investment-grade corporate bonds against default has surged to 127 basis points in 91 days. That's the fastest quarterly expansion in credit default swap, spreads outside of a declared financial emergency, since record-keeping began in 2004. If you hold bonds, if your pension depends on corporate debt markets, if your income relies on credit flowing smoothly through the banking system, something has already shifted beneath you. This isn't a warning. It's a documentation of an event that has concluded. The derivatives market, where the largest institutions hedge trillions in exposure, has repriced risk at a velocity seen only 3 times in 2 decades. March 2008, September 2008, and March 2020. Each time, what followed wasn't speculation. It was mechanical. The question is not whether this signal is real. The question is what breaks first when the cost of safety becomes unaffordable. I'm John A.G., and this is the Collapse Files. Between October 14, 2025 and January 14, 2026, the market CDX North America Investment Grade Index, a benchmark measuring the cost of insuring against corporate bond defaults, rose from 58 basis points to 185 basis points. That represents a 218% increase in the price of protection. For context, during stable periods between 2017 and 2019, this index traded in a range of 48 to 62 basis points. The current level exceeds every reading recorded between 2013 and 2024, with the exception of the March 2020 pandemic shock, when spreads briefly touched 197 basis points before central bank intervention. This is not a gradual drift. The majority of the move occurred across 13 trading sessions in late December and early January. On December 27th, the spread was 94 basis points. By January 9th, it had reached 171 basis points, an 82% surge in 9 business days. The single largest one-day move occurred on January 6th, when spreads widened 22 basis points in a session where equity markets closed marginally positive, and Treasury yields fell. That divergence is critical. It suggests the move was driven not by external shock, but by internal reassessment. The composition of the index matters. It tracks 125 equally weighted credit default swaps on North American investment-grade issuers. These are not speculative names. These are utilities, telecoms, consumer staples, industrials, the core of the domestic credit market. When the cost to insure these entities against default rises at this speed, it signals a fundamental repricing of safety across the entire credit structure. Simultaneously, the high-yield CDX index, tracking sub-investment-grade issuers, moved from 318 basis points to 523 basis points over the same period, a 64% increase. The spread between high-yield and investment-grade protection now sits at 338 basis points, the widest gap since April 2020. That spread measures stress. When it expands, it indicates that investors are not simply seeking higher returns for taking risk. They are refusing to take risk at almost any price. Volume in the credit derivatives market has surged in parallel. Average daily notional value traded in CDX contracts exceeded $42 billion in the first 2 weeks of January. Compared to a 2025 average of $18 billion, this is not speculative positioning. This is institutional hedging at scale. Pension funds, insurance companies, and asset managers are paying rising premiums to protect portfolios they cannot afford to liquidate. What makes this abnormal is not the absolute level of spreads we have seen higher during acute crises, but the velocity and the silence. There has been no credit event, no major issuer has defaulted, no bank has failed, no geopolitical shock has materialized. The move is occurring in the absence of a catalyst, which makes it more dangerous. It suggests the market is pricing in an event that has not yet been publicly acknowledged. This is what Michael Burry watches. Not headlines, not sentiment surveys. The derivatives market, where the cost of being wrong is measured in billions, and where participants have access to information the public will only learn about later. The credit default swap market exists to transfer risk. A bondholder who wants protection against default pays a periodic premium to a counterparty willing to assume that risk. If the bond defaults, the counterparty pays the bondholder the face value. If it does not, the counterparty keeps the premium. This mechanism allows institutions to hold assets they would otherwise avoid and allows risk to be distributed across the financial system. When functioning properly, CDS spreads reflect the market's real-time assessment of default probability. They adjust gradually as economic conditions evolve, credit quality shifts, and interest rates move. The system is designed to smooth volatility, not amplify it. Dealers provide liquidity. Arbitrageurs keep spreads aligned with bond prices. Hedgers lock in acceptable costs for protection and move on. But the system has structural fragility. The counterparties who sell protection are often the same institutions exposed to the underlying credit risk. Banks, insurance companies, and hedge funds sell CDS to earn premium income. but their balance sheets are already loaded with corporate bonds, leveraged loans, and structured products tied to the same issuers. When spreads widen rapidly, these institutions face a dual exposure. The bonds they own are falling in value, and the protection they sold is generating mark-to-market losses. This creates a reflexive loop. As losses accumulate, dealers reduce the amount of protection they are willing to sell. Reduced supply drives spreads wider. Wider spreads trigger margin calls on existing positions. Margin calls force asset sales. Asset sales depress bond prices further, validating the original move in spreads. What began as a repricing of risk becomes a self-reinforcing spiral. The trapped participants are those who sold protection at low spreads and now face unlimited downside, and those who need to buy protection but find the cost prohibitive. In late 2024, many institutional investors sold CDS on investment-grade names at spreads between 50 and 70 basis points, collecting steady income in a low volatility environment. Those positions are now underwater by 115 to 135 basis points. A $100 million notional position has generated a $1.15 million to $1.35 million loss in 90 days, with no maturity date to wait for recovery. On the buy side, the trapped participants are pension funds and insurance companies required by regulation to hold investment-grade debt but contractually obligated to hedge tail risk. As spreads rise, the cost of fulfilling their hedging mandates becomes punitive. A pension fund managing $10 billion in corporate bonds and seeking to hedge 30% of that exposure now pays $55.5 million annually in CDS premiums, up from $17.4 million 3 months ago. A $38.1 million increase in cost with no corresponding increase in asset value. The system is designed to function when risk is distributed. It fails when risk concentrates. Right now, risk is concentrating among those least able to absorb it: institutions with long-duration liabilities, regulatory capital requirements, and limited flexibility to reduce exposure. They cannot sell the bonds. Liquidation would trigger immediate losses. And regulatory scrutiny. They cannot stop hedging. Fiduciary duty and compliance frameworks mandate protection. They are forced to pay rising premiums into a market that is pricing in their own distress. This is the mechanical failure that precedes a credit event. The event does not cause the failure. The failure reveals that the event was already priced in. The 127 basis point move in investment grade CDS spreads represents the third largest quarterly expansion in the index's history. The largest occurred in Q4 2008, when spreads widened 198 basis points as Lehman Brothers collapsed and AIG required government intervention. The second largest occurred in Q1 2020, when spreads widened 142 basis points as COVID-19 lockdowns began. Both episodes were accompanied by emergency Federal Reserve interventions totaling trillions of dollars. The current move is occurring without any such intervention and without any publicly identified catalyst. Breaking this down further, the 91-day period from October 14th to January 14th saw spreads rise from 58 to 185 basis points. That yields a daily average widening of 1.4 basis points, but the move was not linear. The first 45 days saw spreads drift from 58 to 94 basis points, a 36 basis point increase over a period when equity volatility was declining and Treasury yields were stable. Then, in the subsequent 46 days, spreads surged 91 basis points. The acceleration is the signal. Compare this to the 2015-2016 energy sector credit crisis, when oil prices collapsed from $107 to $26 per barrel. During that episode, investment-grade spreads widened 47 basis points over 6 months, less than half the current move, spread over twice the duration, with a clear external shock driving the repricing. The current move has no such clarity. The ratio of high yield to investment-grade spreads provides additional context. As of January 14th, high-yield spreads sit at 543 basis points, while investment-grade spreads sit at 185 basis points, yielding a ratio of 2.83. During the stable period of 2017-2019, this ratio averaged 6.2. During the 2020 crisis, it briefly compressed to 2.1 before central bank intervention restored confidence. A ratio below 3.0 indicates that the market is not distinguishing adequately between high-quality and distressed credits. It suggests systemic repricing, not sector-specific stress. Turnover in the CDS market has spiked in tandem with spreads. In December 2025, total notional value traded in North American credit derivatives exceeded $680 billion, the highest monthly figure since April 2020. January is on pace to exceed $750 billion. For comparison, average monthly turnover in 2024 was $312 billion. This is not noise. This is institutional capital repositioning at scale. The term structure of CDS spreads has also inverted. 5-year protection on investment-grade names now costs 185 basis points, while 10-year protection costs 172 basis points. Inversion occurs when near-term risk is perceived as greater than long-term risk. It appeared in August 2007, 4 months before the official start of the financial crisis, and again in January 2020, 2 months before pandemic lockdowns. The market is pricing acute stress within the next 24 months. Credit spread duration, the sensitivity of bond prices to changes in spreads, has amplified losses. A 10-year investment-grade bond with a duration of 8.3 years has declined approximately 10.5% in value, as spreads widened from 58 to 185 basis points. For a $1 billion bond portfolio, that represents a $105 million unrealized loss in 91 days, with no corresponding equity market collapse to distract attention. Finally, the divergence between CDS spreads and equity volatility is unprecedented outside of crisis periods. The VIX index, which measures expected stock market volatility, averaged 16.8 in December and 18.2 in early January, elevated but far from panic levels. During the same period, credit spreads moved as if pricing in a VIX above 35. This divergence has occurred only 3 times since 2004, mid-2007, late 2008, and February 2020. Each time, equity markets eventually converged to credit market pricing, not the reverse. The numbers do not speculate. They document a repricing event of historic magnitude, occurring in the absence of public acknowledgement, driven by participants with asymmetric information and unlimited capital at risk. The first precedent is the summer of 2007. Between June and August of that year, investment-grade CDS spreads widened from 41 basis points to 73 basis points, a 78% increase in 90 days. Equity markets were stable. Unemployment was 4.6%. GDP growth was positive. The Federal Reserve had not yet cut rates. The credit derivative market was pricing in a crisis that would not be publicly acknowledged until Bear Stearns collapsed in March 2008, 9 months later. What the CDS market saw in 2007 was the breakdown in subprime mortgage securitization. 2 Bear Stearns hedge funds failed in July, revealing that AA-rated mortgage securities were trading at discounts of 30% to 50%. Dealers who had sold protection on these securities faced massive margin calls. They reduced risk by widening spreads across all credit markets, even on issuers with no subprime exposure. The repricing was mechanical. By the time the broader public understood the severity of the crisis, the cost of protection had already tripled. The outcome? By October 2008, investment-grade spreads reached 287 basis points. Credit markets froze. The Federal Reserve initiated emergency lending programs, totaling $1.2 trillion. The economy entered the deepest recession since the 1930s. The signal was visible 15 months before the crisis peak. The second precedent is February 2020. Between February 12 and March 23rd, investment-grade spreads widened from 53 basis points to 197 basis points, a 272% increase in 40 days. This move occurred as COVID-19 spread globally, but critically, it began before lockdowns were announced. On February 19th, the S&P 500 reached an all-time high. On February 21st, investment-grade spreads crossed 70 basis points, a level not seen since 2016. The credit market was pricing in economic collapse while equity markets were pricing in business as usual. What the CDS market saw in February 2020 was the simultaneous collapse of revenue across airlines, hospitality, energy, and retail, sectors representing 38% of investment-grade debt issuance. Even before governments announced lockdowns, corporate treasurers were drawing down credit lines, dealers were refusing to roll commercial paper, and money market funds were experiencing redemptions. The repricing was complete by March 9th. Equity markets did not bottom until March 23rd, 2 weeks later, after the Federal Reserve announced unlimited quantitative easing. The outcome? The Federal Reserve purchased $1.6 trillion in assets over 8 weeks. Corporate bond spreads reversed within 45 days. But the damage was done. Unemployment surged from 3.5% to 14.7%. Millions of small businesses closed permanently. The credit market signal gave sophisticated investors a 30-day head start to reposition portfolios before the public crisis began. The pattern is consistent. Credit derivatives move first because the participants are institutions managing trillions in exposure, operating with real-time data on cash flows, refinancing needs, and balance sheet stress. They do not wait for headlines. They reprice risk the moment internal models indicate elevated probability of loss. By the time the repricing reaches the equity market or the evening news, the opportunity to act has passed. The current move mirrors both precedents in velocity and magnitude. It is occurring without a visible catalyst in an environment where official data shows moderate growth and stable employment. That does not make it wrong. It makes it early. The mainstream narrative focuses on what is visible. Stock prices, interest rates, unemployment data, GDP growth. These are lagging indicators. They confirm what has already happened. The credit derivatives market is a leading indicator. It prices in what is about to happen based on information flows that do not reach the public for months. What most people miss is the incentive structure of the participants. A pension fund managing $50 billion in assets cannot afford to be wrong about corporate credit risk. A single percentage point decline in bond portfolio value represents a $500 million loss, which directly impacts the ability to meet future liabilities. These institutions employ teams of analysts with access to private credit data, covenant compliance reports, and real-time cash flow monitoring. When they reprice risk, it is not speculation. It is response to information. Central banks and regulatory bodies also have incentive to downplay credit market signals, acknowledging elevated stress risks triggering the very panic they seek to avoid. The Federal Reserve's communication strategy prioritizes stability over transparency. Officials will not confirm credit market distress until it has already been reflected in equity markets, unemployment data, or bank failures. By that time, the repricing is complete. The third thing most people miss is the second-order effect on liquidity. As CDS spreads widen, dealers reduce inventory of corporate bonds. Reduced inventory means wider bid-ask spreads. Wider bid-ask spreads mean higher transaction costs. Higher transaction costs discourage trading. Reduced trading volume means price discovery deteriorates. Poor price discovery means investors cannot accurately value holdings. Uncertainty about valuation triggers risk reduction. Risk reduction means selling. Selling drives prices lower. Lower prices validate the original spread widening. This loop operates independently of economic fundamentals. A company with stable earnings, manageable debt, and strong cash flow can see its bonds decline in value simply because dealers are unwilling to hold inventory. The company has not changed. The market structure has failed. The fourth thing most people miss is the role of passive capital. Over the past decade, bond index funds and ETFs have absorbed trillions in inflows. These vehicles hold bonds not based on credit analysis, but based on index membership. When spreads widen and prices fall, passive funds experience redemptions. Redemptions force sales. Sales occur in the most liquid names first, regardless of credit quality. This creates price distortions, where the safest credits decline the most because they are the easiest to sell. Active managers who understand this dynamic can exploit it, buying high-quality bonds at distressed prices, while the passive wave sells indiscriminately. But the majority of capital is passive. The majority does not exploit, it amplifies. Finally, most people miss the duration mismatch embedded in the system. Insurance companies and pension funds have liabilities extending 20 to 30 years. They hold bonds with durations of 7 to 12 years. And when spreads widen, the present value of their liabilities does not decline at the same rate as their assets. The funding gap widens. Regulators do not require immediate recognition of this gap, but it exists. It accumulates. And when it becomes unavoidable, it triggers forced deleveraging across the entire system. These are not hypotheticals. These are mechanical features of the credit market structure, visible to anyone who looks, ignored by those who prefer comfort over accuracy. Credit market stress does not announce itself with headlines. It announces itself with widening spreads, declining liquidity, and rising costs of protection. What we are witnessing is the early stage of a repricing event that will eventually reach all risk assets. The specific catalyst may not be visible yet, but the market's response to unseen stress is already underway. Historically, when investment-grade spreads cross 150 basis points and continue widening, the first thing that breaks is refinancing. Corporations with debt maturing in the next 12 to 24 months face a choice: refinance at elevated spreads or draw down credit lines and preserve cash. Either choice reduces capital available for operations, hiring, and investment. This slowdown does not appear in GDP data for 2 quarters. It does not appear in unemployment data for 3 quarters, but it is already in motion. The second thing that breaks is confidence. Credit market participants are institutions managing other people's money. When they lose confidence in their ability to accurately price risk, they stop taking risk. They move to cash. They refuse to roll commercial paper. They demand higher yields on new issuance. This withdrawal of liquidity does not require a default. It requires only the perception that default probability has increased beyond acceptable levels. The third thing that breaks is the assumption of central bank intervention. Markets have been conditioned over 15 years to expect that credit market stress will be met with Fed asset purchases, emergency lending facilities, and policy rate cuts. But the Fed's balance sheet is already $7.2 trillion. Policy rates are already at levels that create political and inflationary risk if cut aggressively. The assumption that intervention is unlimited has not been tested in an environment where inflation remains above target and fiscal deficits exceed $2 trillion annually. If the Fed does not intervene or intervenes at insufficient scale, the credit market repricing continues until something fails. That failure could be a major corporate default, a bank with concentrated exposure to distressed credits, or a shadow banking entity that sold protection it cannot honor. The identity of the failure matters less than the systemic response. Once confidence breaks, the speed of capital withdrawal exceeds the ability of policymakers to respond. The broader implication is that we are operating in a system where the cost of safety is rising faster than the return on risk. When that dynamic takes hold, all leverage unwinds, not gradually, mechanically. The participants with the most leverage, the longest duration, and the least liquidity are forced to sell first. Those sales set prices for everyone else. Prices fall until buyers emerge or authorities intervene. This is not a prediction. This is a description of how credit markets have functioned in every major repricing event over the past 30 years. The signal is present, the mechanism is engaged. What remains is time. Michael Burry does not wait for confirmation. He does not require a headline, a press release, or a government acknowledgement. He watches the price of protection. He watches the institutions that cannot afford to be wrong. And when they begin paying multiples of historical norms to hedge exposure, he understands that the information asymmetry has shifted. The credit derivatives market is not predictive, it is reactive. But it reacts to information that the public will not see for months. The institutions moving this market manage trillions. They employ thousands of analysts. They have access to private data, regulatory filings, and real-time monitoring of corporate cash flows. When they reprice risk at this velocity, in this magnitude, without a visible catalyst, it is not speculation. It is documentation. What we are witnessing is not the beginning of a crisis. It is the market pricing in a crisis that has not yet been named. The mechanism is already in motion. The cost of protection has risen beyond sustainable levels for those required to hold it. The liquidity necessary to absorb selling pressure is withdrawing. The assumptions that have underpinned market stability for a decade are being tested. You will not read about this in tomorrow's financial press. You will not hear it discussed in earnings calls or policy speeches. You will only see it in the numbers, the spreads, the ratios, the velocity of change. And, by the time it becomes undeniable, the repricing will be complete. The question was never whether this signal is real. The question is whether you're positioned for what it has already set in motion. This is the collapse files. The data does not speculate, it waits.